Welcome to the Explainer. Today, we're tackling something that literally impacts your financial security, mastering the new FBR 2026 draft return. It's a huge topic, so let's just jump right in. We've got to start with a really simple, but honestly powerful question. Why does the FBR target you? Look, it's a super common fear, right? We've all heard the stories. People feel harassed, they feel totally overwhelmed by tax authorities. But what if we completely flip our perspective right now? Instead of looking at this through a lens of fear, let's focus entirely on strategy. Because here is a reality that top tax experts constantly point out. The FBR only bothers those with inaccurate returns. Seriously, it's not some grand personal vendetta against you. It really just comes down to discrepancies in your paperwork. So this new draft return, it isn't a trap. It's actually an incredible opportunity to get things perfectly right, reconcile your wealth, and completely avoid those nasty penalties. So how are we going to do that? Well, here's our roadmap for this explainer. We're covering the FBR 2026 draft return, property, gains and gifts, foreign and Benami assets, tax relief for SMEs, system glitches and deductions, and finally, how to avoid audits. All right, Section 1, the FBR 2026 draft return. There's a really deliberate, kind of fascinating timeline shift happening this year. Historically, things just dragged out until December, but the draft was actually issued early this time around, back in May and June. The financial year closes on June 30th. So what does that mean for us? It means your target for filing should ideally be July. And why does this matter? Well, by filing early in July, instead of waiting around until December, you immediately lock in your active filer status. Plus, you completely sidestep that chaotic, mistake-prone, last-minute panic that triggers so many unnecessary audits in the first place. Moving on to Section 2, property, gains, and gifts. Okay, these are the most heavily scrutinized asset classes right now. Back in the day, the old way, you could basically just enter a lump sum income for your properties under other sources and, call it a day. Well, the new way changes the whole shebang. The FBR is now demanding fair market value comparisons, the national tax numbers of your tenants, and really specific rent details for every single property. It's like a giant puzzle they're piecing together. They're directly comparing prime rentals now. For instance, if you claim the rent for a luxury commercial plaza in DHA is the exact same as a tiny shop in Shadra, yep, they're going to catch that instantly. The days of generic entries are officially over. And speaking of real estate, there's a massive new number you absolutely need to keep in mind: 15%. Under Section 37, there's a mandatory 15% minimum capital gains tax for any property purchased after June 30, 2024. So if you buy property now and sell it later, you've got to declare the exact description and history of that property in your return to make sure this gain is calculated correctly. Wealth transfers are completely under the microscope now, too. The FBR strictly requires you to declare the exact nature of any gift, the NTNs of both the person giving and the person receiving, your specific relationship status, and a highly detailed description of the property. Those casual, undocumented cash gifts people used to use to bypass the system? Yeah, absolutely no way. Those are completely out. Precise tracking of property gifts to relatives is mandatory now to verify your wealth reconciliation. Section 3, foreign and Benami assets. This part is absolutely crucial for anyone dealing with offshore money or domestic assets hidden in someone else's name. Let's look at the 50 lakh or 5 million rupee threshold. Previously, foreign remittances up to this amount were generally safe from deep scrutiny under Section 111, which deals with tax evasion. But now, even for exempt foreign remittances under 50 lakh, you literally must declare the sender's name and the country of origin. The transparency net is expanding everywhere. Furthermore, providing a foreign tax ID and country of origin is now legally mandatory when they're declaring foreign income. Now, I know what you're thinking. This sounds like just another pile of frustrating paperwork. But actually, scratch that. It's really more like a protective shield. Giving them this ID triggers an automatic international verification through existing global networks. So, if you've already paid tax on that money abroad, the system verifies it and protects you from unfair double taxation back home. Then we've got Benami assets. These are properties or vehicles you genuinely own, but for whatever reason, they're registered under a relative's name. The new rules require the relative's NTN, their overseas identity card, or NICOP if they're living abroad, and the specific vehicle registration numbers. And look, by explicitly listing these assets held in a wife or child's name, you're actually protecting both yourself and your relative during cross-verification. It stops the authorities from auditing your family member and incorrectly assuming they're hiding undeclared wealth. All right, Section 4, tax relief for SMEs. Okay, we've talked a lot about restrictions, so let's pivot to some truly empowering news that honestly is far too often ignored by small to medium manufacturers. This new structure under Section 100D, it is a real game changer. Check this out. If your manufacturing turnover is up to 10 crore, so 100 million rupees, the normal tax rate would be 7.5%. But the SME turnover tax rate is a microscopic 0.25%. And if your turnover is up to 25 crore, normal tax is 15%, but the SME rate is just 0.50%. For folks who might otherwise get slammed with brutal standard tax rates soaring up to 45%, opting for these SME rates completely bypasses that heavy burden. It's a massive, massive opportunity to build white money and legitimize your business for a fraction of the cost. But you knew there was a but, right? There is one crucial catch here. The SME scheme requires a strict 3-year lock-in period once you opt into it. Committing to this highly protective relief means you are staying in it for 3 consecutive years. You can't just bounce in and out whenever it's convenient, and obviously, if your turnover exceeds 25 crore, you age out of the benefit. Still, for genuine small manufacturers, this is an incredible legal advantage. Which brings us to Section 5, system glitches and deductions. We know there's a real-world friction out there, and frankly, the FBR's current portal has some severe technical flaws. These are the specific minimum tax glitch areas that are absolutely frustrating tax practitioners right now. Section 148 for imports, Section 153(1)A for supplies, and Section 153(1)B for services. The automated software is just fundamentally failing to correctly process minimum tax deductions in these specific categories. Basically, the system fails to give you full adjustment credit, so it ends up generating false tax liabilities, even when you've made totally legitimate income declarations. Just imagine having 4 crore deducted in tax, properly declaring your income to match that exact amount, and the system still blindly demands you pay millions more. It's wild. It blocks valid refunds and demands unjust payments, all because the software's formula isn't matching the actual tax law. So if you run into this, take a breath, you are not alone. Tax practitioners are actively pushing the authorities to fix this whole mess. And finally, Section 6, how to avoid audits. Let's pull everything we've talked about together into an actionable strategy. We need to completely reframe how we view our tax returns. Think about this. Your return declaration is seen by anti-corruption watchdogs like NAB, investigative agencies like the FIA, civil courts, and even the Supreme Court. Your tax return is not just some annoying form you scramble to fill out once a year. It is your ultimate legal and financial passport. It's the core documentary evidence of your entire financial life that holds up in any court in the country. And this leads us to a super important comparison: the trap versus the shield. The trap is paying some unregistered property agent a few thousand rupees to file a cheap, fake, nil return just so you can quickly get on the active taxpayer list. Sure, you might save a tiny bit of cash today, but you are creating a massive, unreconciled discrepancy that is practically guaranteed to trigger a very painful audit down the line. The shield, on the other hand, is a fully reconciled wealth statement, where you honestly document your assets and pay your exact dues. An honest return means you can confidently stand before any department knowing your foundation is rock solid. So, here are 4 essential steps to take total control. Step 1. Gather all your documents early. Don't wait for a notice, just attach them right into the system now. Step 2. Audit your own wealth statement before the authorities do. Make sure every single asset, rent, and gift connects logically. Step 3. Pay the exact tax due. Paying your fair share makes your file ironclad. And step 4. Never ever file a fake nil return. Just don't do it. I'm going to leave you with a final provocative thought to chew on. Will your 2026 tax return be a dangerous liability or your ultimate financial shield? The choice is entirely in your hands, and it all depends on how you prepare today. Review those financial documents, embrace the new transparency, and file accurately. Thank you so much for joining me on this explainer, and I will see you next time.